Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today's stock is symbol IWM. That's the iShares ETF that tracks the Russell 2000 index. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey. Well, we have a Monday that is down. We see the S&P 500 index down a couple percent here. What do you see going on in the markets this week?
Yeah, it's not a pretty morning, not a great way to kick off the markets, but I gotta say, what we're seeing today is a continuation of what we saw over the past 3 weeks. 3 weeks of declines for the major indices, and it continues to move lower today. But today, what's driving things ever since we got into the month of September, which we know is an unseasonably weak period for the stock market. Today, we're the key drivers really are coronavirus, the spikes that we're seeing out of Europe, especially France. Over 10,000 new cases were reported on Sunday. The UK, 4,000 new cases. There's speculation out there, Brian, that the European governments are going to reimpose restrictions in some regions. And so I think the fear when you think domestically in the US is that could that happen here if we are to get a spike like many people had predicted all summer long with the flu season taking off. If we get a spike here, are we going to also see increased restrictions, tracing back of that reopening story that we had seen and the economic data had borne out? Is that going to turn around? And so I think people are a little bit nervous about that. Also, the CDC over the weekend didn't help things by kind of changing the way that they believe that the virus is spread. So there's question marks there. And I think I kind of find it almost, a little bit funny because over the summer, we in the US saw a major spike in coronavirus cases while the rest of the world was able to keep things at bay. And even in some parts of the world, we're able to see cases decline. So over that period of time, which we have endured successfully so far, knock on wood, I can't predict the future. But during that period of time, the US government did not reimpose restrictions in different parts of the country to shut down, to go back inside, to close restaurants and bars and things like that had been given the green light to open to, at low capacities, but still open. So we didn't see that happen over the summer. And I think with the election in front of us, just over a month away, by the way, the government is not really going to have as much of an appetite for that type of action at this time anyway. So I think that this sell-off could be a little bit potentially overdone, but it's a continuation of what we've seen actually over the last several weeks. Like I said, we're really back to where we were at the beginning of August or so. So we've only lost the gains that we saw in August, which, by the way, were outsized by historical standards. Usually August is a pretty flat month, even a little bit of a weaker month. So we're just kind of giving that back. So you're seeing the market react to that news today. Also, there was a report out on the banks that they had been illegally transferring money between, I think it was 1999 and 2017. So you see HSBC and Deutsche Bank being hit the hardest, JP Morgan trading lower also. So I think that is playing a little bit of a role. China trade tensions over the weekend. Trump banned WeChat and TikTok. And then China came back today and they released their unreliable entity list too. So there's a little bit of friction there. There's a couple of different things moving the market, but all in all, I think this is just more of what we had expected when we talked about, Brian, we've been talking about it for weeks, the return of volatility, the markets in the fall. It's a seasonally strong period for volatility. And then also we have the election coming up. And I know you're going to talk about that, what indicators you're looking at heading into that in a little bit. But that's there's just a lot going on right now. I will note, though, that, Brian, the VIX is above 30 again here. But the 10-year yield has been hanging in there. It's been pretty stable. It moved up a bit higher in mid-March, and it's been able to stay in this range over the last month or so. And so to me, that's a positive sign. But the VIX hasn't really been able to come back to those historically normal levels, which is usually below 20, below 19. The market still seems to be a little bit on edge. What do you make of the moves that you've seen recently in the VIX, Brian, and what can we tell from the future curve in the VIX that you've been looking at?
All right. Okay, so I have my little watch list up that we've been highlighting the last couple of stock plays of the day, and it's a VIX watch list. It actually highlights the futures marketplace. So we see here, if I look at the VIX actually, it was at 30 before we started our call today, but it's actually came down just a little bit. But we're still very high on volatility in general, and we have been ever since the big downturn in March. We're at a 20, let's call it 29% implied volatility right now on the VIX. Now the VIX, once again, it tracks the implied volatility of the option contracts in the S&P 500 index. But what I have noted, which is of more interest to me, it's not necessarily as interesting where the VIX is right now, but if we look at the futures contracts, this is the October futures contract. This is the November futures contract. These are symbols, these are indexes that the Chicago Board Option Exchange put together to track the futures market because they trade options on the VIX. And guess what? The VIX options actually follow the futures market. So with that being said, we see that the October and November volatility really took a spike. Now, if we go out to December, we're still over 30 on it, but the October volatility is up 157 today. The November's up 110. So VIX being at 28, it's usually a mean reverting index. In other words, it has a tendency as you go out further in time to trade back towards its mean or its average. And that average on a 200-day basis is going to be below this 28 level. But the marketplace is showing a lot of nervousness in the market by going out further in time and seeing an increased VIX index. October trading at 3160, November trading at 3190. That's quite a bit higher than where the current spot price is at on the VIX, 2864. Now we have just a little bit of a chart here, and you kind of see at the beginning of September, we did have a spike up above 35 on it. But today we ran up on the VIX on the open, and it's kind of interesting that it's settled back down, even though the markets are still down around 2% in general across the board. Now, so that's a little bit nerve-wracking, and we've been highlighting that on the stock play of the day. But now today we're going to talk about the Russell 2000 index. We haven't looked at it that much, but here's part of the reason why. We're going to be a little bit bearish on the Russell 2000 index, and I'll let Lindsey speak a little bit about that, but I want to highlight a couple of charts here. We started on the SPX. This is actually a channel, but I kind of just drew a little support line here on the downside. And we broke through that. We paused a little bit here on the 50-day moving average, but now we've broken through that. And you see right here, there's a little bit of support right across here. There was a gap all the way back here. On the downside, when the market started to turn, we came up and hit that, and that provided a little bit of resistance. And guess what? Now we're right there. If we break through that to the downside, we're seeing the 200-day moving average maybe come into play. The moving averages have really provided support and resistance throughout this entire trading since the March lows. So now if I go back and I look at the NASDAQ, well, the NASDAQ actually even looks a little worse than the SPX, if that was possible. Now, look at this long bull channel that we had already since the March lows. Well, we've broken through that. Once again, the 20-day provided a little bit of support along with the channel. Then we hit the 50-day, and now we've broken through that. So now the 200-day is still down here, at the bottom of this range. And if we look at before the March lows started, this is an area of interest. Now, the interesting thing, though, from looking at these charts is if we jump over to the IWM, which this isn't the Russell 2000 index, but it's the ETF that tracks it, and you see just a lot of chop in the marketplace. We have kind of a range right here between this high and 160 as the high, and we broke out of that range to the downside, but we still see a lot of chop. Bounced off the 50-day. Now we've broken through it. The 200-day is right here. And this is a real interesting area because we had this big gap to the upside. And if I'm highlighting it right here, there's a big gap that comes to the downside. Now, the one thing about the Russell and the IWM is it's it trades to its own song, if you will. So looking at technicals is a little tough in the Russell, but what I find interesting is when you compare it to the SPX chart and the NDX chart, that the Russell is actually holding up better than the other two indexes that have led us out of these March lows and out of this pandemic trading that we've seen over the last 3 or 4 months. So with that said, I'll let you speak to a little bit on the IWM, and then we'll get back into our option trade for this week.
Right, thanks, Brian. So before I dig into it, just wanted to remind our viewers that Brian and I will take your questions at the end of the show. So be sure to type into the box on the right-hand side of the YouTube channel here, and we will get to as many questions as we can at the end. So please participate if you have any questions. So looking at the IWM, like Brian said, it's the iShares small cap index. It looks to track the Russell 2000. This index actually has, Brian described it perfectly, it's held up pretty darn well over the last several weeks, while the S&P 500 and the tech-heavy NASDAQ really came under pressure. So last week, the Russell 2000 was up 2.6%. It was the best performing index of the major indices. So that caught our eye. And then today's action, and with the news that is driving today's action, of course, the IWM and the Russell 2000 are both down today, along with the broader market. But this caught our eye, and given the strength that it has had and the stability that it's had over the last several weeks, and based on what we know about the other two indexes, we are worried that this one could also come under pressure like the other two, especially because what's driving market action, like I said at the top of the show today specifically, is concerns around the coronavirus crisis. I got a little tongue-tied there. And the potential for a shutting down of the economy again, or increased restrictions at the very least here in the United States. That would certainly put a dent in the reopening story that so many investors had been hopeful about, and has helped drive this ETF higher since its March low. Off of its 52-week low in March, it's up about 54% since then. So it's had a great run, just like some of the other indexes. But at the same time, it hasn't been able to break above its old high. So people had originally liked the Russell 2000 as a reopening investment. If you believe that we're going to continue to see economic data improve over the coming months, this was an ETF that you could easily diversify into, focused on small cap companies, small businesses that are likely to benefit as things continue to reopen at an increasing pace. So I think that's why a lot of folks like this one, especially once things started to improve after the summer spike in coronavirus cases. Oh my God, I can't speak today. But yeah, so I think that's why a lot of people kind of had flocked to this ETF and this asset class in general. But as we look forward, if there is a concern, the weather's starting to get cold, people are worried about flu season picking up. So there's a concern that, hey, we could have another spike up in coronavirus cases And if that leads to a slowdown in the reopening story, then these guys are the ones that are going to get hit the most. Also, by the way, impacting this asset class in particular, again, focused on small businesses. So, some of them might be restaurants and bars and other consumer-facing companies that could be hurt if things do start to close down a little bit. So those are companies that are going to need more stimulus, and we've seen the government dragging their feet on providing these companies additional stimulus after the PPP ran out this summer. And the concern is that with the election coming, that a lot of market participants were kind of not really anticipating any stimulus before we got to the election anyway, given how long we've already dragged our feet on that. But with the death of Supreme Court Justice Ruth Bader Ginsburg over the weekend, that has been brought to the forefront and seems to be a priority of the two parties who could drive a contentious fight for that Supreme Court justice position. President Donald Trump is expected to announce his pick for the court on Friday or Saturday of this week. And there's expected to be, both sides are already posturing for who they expect and what they expect for that seat on the court, because it is a lifetime appointment. And if that really takes the forefront of the conversation going into the election and stimulus gets pushed out even further, these are companies that are going to be negatively impacted by that. And so I think that's why it's a possibility that this ETF could come under pressure in the future, or in the near term at the very least. Also, the other thing I always look at, Brian, I've talked to you about this before, is that with the small cap companies, they have much higher debt levels than some of the large cap companies. And that was true going into the pandemic. So the net debt, what I oftentimes look at is net debt to EBITDA. So it's a sense of how much debt a company has versus its profitability. These small cap companies, I looked at the S&P 600 for the analysis. They had more than twice as much debt going into the crisis than they did at the peak of the 2008-2009 financial crisis. And once the pandemic hit, it was much more difficult for these companies to gain access to the debt market, even though the Fed was in there really supporting as much as they could the operation of the debt and also the equity market. It was the bigger companies that were able to reach those markets first. There's been stories out there that not all the smaller businesses, mostly private, is when you read that in the newspaper, didn't get the PPP loans that they deserved. You could probably guess that some of these, the companies included in the Russell 2000 were part of that as well. So there's concerns that these guys don't have enough to fuel their future operations from a capital perspective, and they've taken on so much debt that if profitability continues to be weak going forward, will they be able to survive? So there's a lot of reasons that pressure could come upon these companies, at least in the very near term, and that's why we decided to take a look at this particular security today, the IWM, again, tracking the Russell 2000. And so with that, again, a lot of information there, but I wanted to give the pros and the cons, why people liked it coming into this week and why it might be under pressure today and in the near term. So Brian, I'll pass it to you to get into the specific trade that you're looking at. I know it's, again, this whole program is just really educational for all of our viewers and should not be taken as any advice here. So I'll pass it to you, Brian.
All right.
And again, well, before I do that, one more time, ask questions, guys. Please ask questions in the chat box.
Yes, questions in the chat box. If you have them, we'll try to address them at the end of the show. Long put spread, that's going to be the trade for this week. Now, last week, we actually did a speculative trade around earnings on FedEx, and that trade actually panned out on a paper trading basis. But now the market has taken a turn. FedEx is down with the rest of the market right now. So we're going to look at a short-term long put spread. And if we're looking at any type of spread on a short-term basis, it's considered a speculative trade. So what we're gonna look at doing is buying a little bit in the money put and sell a little bit out of the money put. There is a lot of volatility in the marketplace. We talked about the VIX being up around the 30% level. Now, if we look at the short-term options, in particular on IWM, we're going to see inflated volatilities. And when we have that, we got to be very careful as to how much time premium we're buying versus how much time premium we're selling. It becomes a different marketplace to trade in when implied volatilities become elevated. And since we've already had a fairly big down move in the marketplace, that is definitely the case here. So this is a long put spread inside the Ally Invest Options playbook. This is the stock price at expiration on this axis, and then we have the profit and loss graph. So in this instance, the stock's going to be right about here. It's going to be just below strike B. That's our long strike that's doing all the work for us. But it's going to be so right about here, just a little bit below strike B. And then we're going to go further out of the money and sell a put to help pay for strike B, which is doing a lion's share of our work here. So if we go to the Ally Invest option chains, we see that the Russell is now down 4%. So it's taken a little bit of a worse turn since we started the show here at 147.24. So that's an interesting level because that's right where the 9/11 low was on the chart, if I recall. I actually might take a peek to go back here and kind of look at that chart because now I find that interesting. Okay. So right at this level, yeah, we've broken down. So the low of the trading channel was on 9/11. And it looks like we've kind of broken through that level now in the Russell. So 200-day moving average would be an interesting area. So with that said, let's get to this week's paper trade. Okay, so we're going to only go out about 9 days. So it is a short-term trade. We're going to go out about 9 days. Part of the reason why is that there's so much premium in these option contracts. If you are correct on your forecast, you want to be able to get paid for your trade. And if we see here in the IWM, the option contract that we're going to buy is the 150 strike. Stock is at 147. Let's round down to 147. We're going to buy the 150 strike, and we see that's trading at about 36% implied volatility. So if I take a peek at the call side of the chains, this is the put side, we look at the call side, we see that we're buying about $1.65 worth of time premium, give or take. That's just a kind of a quick and dirty way to see how much time premium we're buying. And then if we sell the 140s here, we're bringing in about $1. So in this instance, we're going to have about 60 cents worth of time premium in our entire trade. So because implied volatilities are so high, we're definitely going to be buying one and selling one. And the time period that we pick is also going to be important because as expiration approaches, if we're correct on our forecast, that's when our trade will max out closer to expiration. So what does that mean? That means we'd rather have the stock be at 140 9 days from now than at 140 tomorrow. The trade will do better because we need this option contract that we're selling, this out of the money option contract, to get some time decay in it. We need that to kind of wither away a little bit for us. So paper trade for this week is we're buying the September 30th 150 strike put, going further out of the money and selling the 140 strike put. When I was looking at this before, it was at 376, but now 392, it's $4 on the natural. Well, if we call it $4, which is a dime higher, I'd think that we'd want to try to work it somewhere in here. But if we call it $4, then the math's really easy. All right. If it's $4, let's put it in the right rail. We'll make it the official paper trade for this week. And as Lindsey mentioned, it's not meant to be a recommendation. We're just trying to learn here. I'm going to put $4 in the box. I would probably work it around 392 or so, but let's just call it $4, make it simple. That means that we have $400 of risk for every 1-by-1 spread that we do. So it's going to be $400 plus commission to put on that trade, but we have a 10-point wide spread, the difference between the strikes. So we have $6 worth of upside. So we are trying to position ourselves where we have, if we're correct on our forecast, we can make more than if we're incorrect. And that's kind of the goal here by buying a little bit in the money and selling a little bit further out of the money on our long spread. So $400 plus commission, that would be our max risk. And this will officially be the paper trade for this week. Now let me scroll down a little bit and I'll just show it to you in the profit and loss graph, okay? This is as of today, the profit and loss graph. So we see the colored line is actually the strategy when we first put this on. And this is kind of what I'm talking about. The market is right here, right below strike the strike that we're buying, the 150 strike. This is line represents where the underlying stock is at. But you see, if we go right down to 140, we would be profitable on our trade, but we're going to be much more profitable at the dotted line, which represents expiration. So let's cut the days to go, very close to expiration. And all of a sudden you start to see the as of today graph get a little bit closer to where the dotted line is at. So that's what I'm highlighting. We got to be very choosy when we have a high implied volatilities in the marketplace. And we have to be very choosy with our expiration date, because if we're correct on our forecasts, we also want to be able to get paid on that trade. Now, with that said, there's a downside to it too. If we're incorrect on our forecasts, though, we'd want to be incorrect sooner rather than later, because once again, it provides us this time value provides us a little bit of protection. So if the market goes against us, and then against us would mean that it started to go up, if it happens right now, we're going to be better off. We can sell and salvage some of our position, as opposed to, let's go all the way back down to 1 day to expiration again, closer to that expiration date. All right. So that's going to be it for the paper trade. Officially, we're doing a long put spread in IWM using the September 30th expiration. All right, Lindsay, do we have any questions in the chat box?
Yeah, we do. We've got a couple. Scotty B asks, if implied volatility is so high, why not just buy a put?
Well, if you buy the put when implied volatility is high, you are paying a lot of time premium. And so if you're just buying that, you're trading the swings in implied volatility as much as you're trading the price movement. By doing the spread where you're buying one that wants the implied volatility to go higher, and you're selling one that wants the implied volatility to go lower, you kind of take that that variable a little bit out of the picture. Now, we are buying a little bit more time than we are selling, so we still have some susceptibility, but not as much as if we just bought the put outright.
All right. And then we've got another question for you, Brian, from Lindsey Zoo. What is the difference between a long put spread and a short call spread?
Okay, they both have the same outlook on the market in that they do want the markets to go down. If we're looking at a short call spread, that is also called a bear call spread. They're usually done further out of the money, and they usually have a little bit higher probability of success. In our long put spread, we paid $4 with the potential to make $6 if our forecast is correct. If you're doing a short call spread, you usually have your upside is going to be much lower and your risk is going to be much higher. But you're going to go further out of the money, so you have a higher probability of success. And that's the way option trading always is. If you have a higher probability of success, then your reward isn't going to be as great if your forecast is correct. So a short call spread is a viable way to look at it, to a viable trade based off of this forecast. But with the markets as volatile as it is, I'd rather give myself a little bit more upside than taking all that risk if I'm wrong and having more downside like I would on a short call spread.
All right, that's all we've got today. And I think we're just about at time anyway, Brian. So I think that'll do it for the show.
All right. Well, this Friday, I'll come back and review our long put spread in the IWM. We have the stock play of the day overtime every Friday at noon Eastern time on YouTube, on the Ally Invest YouTube channel. And also, I want to remind you, please click subscribe and ring the bell. Then you'll get all the alerts for all the stock play of the days. So I'll see you this Friday. Thanks for coming, everyone.
Bye, everyone.